So we'll kick off as always. Let's check in and see how major equities in Africa are doing at intraday. On the second day of trading day of the week, we see sentiments at intraday were negative on the African continent. We see Nigeria's NGX was down 0.05% at intraday, still hanging on to the 99,000, but hopefully we cross 100 at the close of business. I'm hoping for a miracle. And this was led by losses in the oil and gas sector. We see O&O and Eternal really dropping at intraday. Now, South Africa at intraday was down nearly 1%, 0.96%. And now let's look at Egypt. EGX 30 was not doing well. It was not doing well at intraday, 0.11%, and down to 27,921 points. Meanwhile, Kenya's Kenya's exchange, closed Monday's session in the green, 0.09%. But away from equities now, let's look at Nigeria's fixed income space, keeping an eye on inflation data that was out yesterday, and headline inflation printing at 34.19%, which feeds to the cost of borrowing. Let's talk to Chuka Nwachukwu, is the group head, Assets and Liability Management, UBA. Good afternoon, Chuka. Chuka, Nigeria's inflation has surged now to 34.19%, and recent bond auctions have shown a decline in government bond offers. Now, given this persistent rise that we are seeing in headline inflation, how will this affect the government's borrowing strategy?
Thank you, Will. Like you rightly mentioned, the inflation result came out yesterday, and we saw about 24 basis points movement from 33.95 to 34.19, pardon me. So basically what this means is that investors will demand for higher yield in the fixed income market, even though the government has practically met his threshold in terms of borrowing, but we expect that this will affect government's repayment plan, especially with high yield. And so government will definitely we look for other means of meeting up some of the borrowing from the budget, being that the yield, the increment in yield which investors will demand for, will mean that government will borrow more, and will mean that government will pay more than what they are supposed to pay. And so this will affect government borrowing towards the end of the third quarter, and then probably end of the year.
Okay, speaking of high interest rates, that's high repayment for loans. Last week, the central bank governor, that's Mr. Yemi Cardoso, assured that high interest rates would soon decrease based on the 6 consecutive months of decline in month-on-month inflation. However, we've seen that there's now a rise in month-on-month inflation for the first time since February. Given this development, is a hold or a rate cut still possible? What are your expectations for interest rates as the central bank's MPC meets next week?
While the central bank governor has indicated that we are approaching the end of the high interest rate period, the month-on-month inflation rate has declined slightly. If you watch the inflation figures, you see that the disparity between what it was, towards the end of last year has reduced significantly. And what that means is that the hiking rate, is giving a positive impact. As the inflation rate has slowed down significantly, accordingly, we believe that MPC will either maintain or probably just move it up by say about 50 basis points, because we have seen that the impact it's in the economy is beginning to yield results. No minding what the result is as this last time, but then if you drill down to the core aspect of the core figures, you discover that is the agricultural sector as well as the petroleum sector that is causing the much higher higher rate higher increment in inflation. And I believe that with the president pronouncement of 2 trillion pumping into the agri sector, we begin to see reduction in food price.
Well, we'll wait for that. What's the current market liquidity? How is it affecting the types of instruments investors are buying at intraday?
As they say, cash is king. System liquidity has been very tight. Today, system liquidity opened in deficit of about 850 billion. That is quite huge, and that has affected trading on the fixed income market, especially when traders need liquidity in order to settle some of the obligations, and so it will affect. It has affected trading in a sense that most traders are demanding for higher yield, and then of course most traders are also selling off even at a loss in order to meet liquidity obligations. So what we've seen so far is that traders are playing on the shorter end of the curve, especially on the T-bill side, 90 days, 182 days bills, a maximum 1 year. And we haven't seen a lot of major activity on the bond side, which of course is the higher instrument, and then of course higher duration securities. So just to play safe, traders are playing on the shorter end of the curve.
Thank you so much, Chuka Nwachukwu. Very interesting analysis there. Chuka Nwachukwu is the Group Head, Asset and Liability Management, UBA. Thank you for coming on Business Incorporated.
Thank you.